What do you make of just how challenging it is from here for the banks that don't have necessarily that strong M&A push, the trading revenue to contend with, but may see a pickup in other areas, particularly around the loan portfolio?
Yeah, loan growth is going to be incredibly important to them. And I think we saw some of that coming through from both JP Morgan and Wells, funnily enough. There is a cost to grow, though, and that's what we're seeing, I think, in Q4 for some of the big money centre banks in the US to begin with. And you say outside that excellent M&A revenue that they've had to acquire talent to kind of get that growth on board. I think we're seeing that cost being taken up front in Q4. The release of reserves that we're going to see as well for some of them will offset that to a degree. But it may be Q1 for JP Morgan in particular to see excellent growth. We like JP Morgan, continue to like them from both a debt and an equity perspective.
Luke, we are seeing around this increased interest rate expectation environment that a lot of investors have just been moving into a basket of banking stocks. But if we start to get more interest rate rises globally, what does it do in terms of sector positioning or positioning inside the sector, I should say?
Well, what a start for the year for bank investors. It's been phenomenal for them. I would caution, however, I think higher rates are no bad thing for banks. It helps in terms of their net interest income, especially with a steeper curve. But expectations are getting well ahead of themselves in terms of the rate and size of those rate rises. I don't think we get a 50 basis from the Fed in March, for example, and I still think we only get 3 this year. That may start to reduce the expectations for banks and maybe weigh on them a little bit as we get through maybe into the second half of the year. But right now, they are the hot place for investors to be, and I don't think there's much in the way of that.
Yeah, I'm puzzled then, Luke, given what you've said, and in particular about JP Morgan. I'm puzzled by the market reaction on Friday. We know that the banks have had a relatively strong run up to this earnings season. But on Friday, the market seemed to say, well, good, but just not good enough on these multiples.
Yeah, and I suppose that the whole market at a 20 times multiple in the US, banks, I think, still look pretty reasonable in a 10 or 11 context where you can get as a broad basket of banks out there. For things like JP Morgan, maybe a little bit of disappointment around the revenue growth and the cost growth. But as I said, I think you've got to buy in that growth. The costs are going to come forward. I think investors have moved past it pretty quick. And Wells Fargo, which, let's be honest, is a bank that's got its problems, 21% year to date. That's a pretty big positive indicator from investors.